Okay. Leverage. Ask your neighbor, what is leverage? Ask the other one next to you, what is leverage?
What is leverage?
Did they respond? No. Oh, they don't know what it is. Okay, so according to the English dictionary, how would you define leverage? According to the English dictionary, how would you define leverage?
Basically, leverage is something that enables you to do something, let's say something bigger, obviously from a smaller point of view. Maybe I'm talking actually in terms of the Forex actually, because I seem to understand what leverage is.
The Forex side.
The Forex side. So basically, if I'm using something as a leverage, it's helping me to, let's say, to lift something big that I wouldn't be able to lift.
Exactly, right? It's more like what? An added advantage, huh? Right, okay. Same thing in trading, guys. Same thing in trading, right? So, let me take you back to history. Right. So you need to note something. So back in the day, guys, trading was only for the big players. It was only for the guys that had serious large amounts, a million. Right. Literally, you and me with our small monies, $100, $1,000, $2,000, we couldn't really participate in the market, right? Because of our investment, right? So, I'm going to show you, we're going to actually do an example here, right? One without leverage and the other one with leverage. Is that cool? Okay. Right. Let us trade, huh? Okay. So, I'll divide my board into two. I'll do the one with leverage on the other side, the one without leverage this side. Right, so account balance, this is you. How much do you have in your account? Let's say $100, huh? Cool. You have $100 in your account, right? Okay, so give me a currency pair. Let's say you decide to trade dollar rand. Cool. So we're about to trade dollar rand. Right. Let's say the exchange rate is at 13.5. So current exchange rate is 13.5, huh? Right. So when the exchange rate is at 13.5, right? In this example, guys, my assumption is we're risking the whole $100. Cool? Okay. So how much is my $100 worth in rands? Right? How much is my $100 worth in rands at an exchange rate of 13.5? 1,350. Right? Okay. So we're now jumping into the markets. Right? We're going longer. Boom. So here we buy. And we're expecting the exchange rate to get all the way to, let's say, 15, huh? So 15. Cool? So let's say the exchange rate moves 13.5, 14, 14.5, all the way to 15. Gets to 15, huh? Okay, so how much is my $100 now worth at an exchange rate of 15 in rands? 1,500, huh? Okay, how much profit do I make in rands? How much profit do I make in rands? 150 rands, huh? Okay, someone with a calculator, I just need assistance here. Right, how much profit do we make in US dollars? We have to divide the 150 rands by the new current exchange rate, huh? which is 15, right? Which means that we make a profit of $10, huh? Boom. Congratulations, guys. You just made $10. Right. Okay. Fair and fine. We see the profit has come, huh? Right. But can you guys agree with me something? It's not like the exchange rate is going to move from 13.5 to 15 in a day. Right? Do you all agree to that? Yes. This could literally take 3 months. Is it possible? Yes. 3 months. Imagine 3 months for the exchange rate to move from 13 all the way to 15, right? And you're only making a profit of $10. Painful, huh? Very hard, huh? Okay, so this is what then your broker did, right? Because, like I was telling you, the financial markets, they were just for the big players. Guys that had money, $1 million, $2 million, whatever, they were the ones that were able to what? To get into the game, and they'll make what? Serious amounts of money, huh? Because you agree, if I add 2 more zeros there, definitely the profit adds up by 2 more zeros, right? Okay, so your broker now sat down, and I was like, how do I get you and me to get into the markets with our small little investment, huh? Of $100, right, 1,000 and all that, right? Then he came up with this thing known as leverage, right? So what is leverage? Leverage is a financial tool, right, that helps traders to control large amounts of money that exceeds their actual investment. Right? So what that means in layman's terms, right? It just means that you might have $100 in your account, right? But actually, when you're trading, you might be trading as if you have maybe 50,000. Yeah, people are now smiling, like, yeah, yes. Right? You get it? Okay. So, usually leverage is more of, they give it as a ratio, right? So brokers today, right, they offer a leverage of up to 1:500, right? Okay, do you guys want us to do the example with leverage now? Do you want to see how it will turn out? Okay, right. So our account balance. We're starting off with $100 huh? Okay. Our leverage is 1:500. What this means is for every dollar that you deposit into your account, right, you're trading as if you have 500. Hey. My brother, you should see the smiles. Like, yo, yes. Okay, so 1:500, huh? Okay, so what is our leveraged? I'll put an L, right, to indicate this is a leveraged account. Leveraged account balance. Right? We need to multiply our 500 times what? 100. So we're trading as if we have 50,000. You follow? Okay. So, right. We're now getting into what? Into trading, huh? Boom. So, we're choosing dollar rand. Current exchange rate is 13.5, huh? 13.5. Then what is our leveraged account balance? Equivalent to in rands at an exchange rate of 13.5. How much is this 50,000 worth in rands at an exchange rate of 13.5? 675,000 rands, huh? Okay. Then, we're going long, huh? So, we buy, and we're expecting the exchange rate to get all the way to 15, huh? Okay. Right. So, let's say the exchange rate now moves, huh? 13.5 all the way, and then gets all the way to 15. Now the exchange rate is at 15. Right. So what is our leveraged account balance worth in rands at an exchange rate of 15? The 50,000, right? Right. What is it equivalent to at 15? 750,000. Right. How much profit do we make in rands? 25,000. 75,000. 75,000 rand. That's your profit, huh? Okay. Then, what profit do we make in US dollars? What profit do we make in US dollars? We need to divide this 75,000 by 15, huh? The current exchange rate, huh? Right. Then what do we get? This will be 5,000. 5,000. Wow. It's a lot of money, huh? Right. Can you see? Here, you're not using any leverage. Yes. Right? You don't have any leverage. Right? But then, you now come to this part and you have leverage and you literally make $5,000 from your initial deposit of $100. Right? Can you see the benefits of leverage? The purpose of leverage? Right. So basically, leverage is important so that what? It accelerates your profits. Your profits. Because remember, this we'd say this can happen in 3 months, huh? Right. So imagine 3 months and you're waiting and you make 5,000. It's worthwhile, huh? But if you're making $10, it's not worthwhile. Can you now see why trading was mainly for the big players alone? Yeah. Okay. I think I had a question there. Okay. Question. Yes.
I wanted to ask, leverage makes you win big, right? At the same time, you might lose big.
Exactly. I was about to get there. Yes. Okay. So, did you get his question? So basically he's saying, Munashe, yes, you've told us about this leverage thing. I've got it. It accelerates my profit. But here in this example, right, I was right. I was going long. But what if I was going short? Are you telling me that I'll be now indebted to the broker by 5,000? And the answer is no. You won't be indebted to the broker, right? So this is what the broker did, right? He came up, because he understood that, you know what, traders, you enter a position today and you say it's going up, but actually it's going down, huh? Right? So he would end up losing his own money, right? So he was like, right, to assist and make sure that you don't end up owing me anything, right? He then came up with this system that's known as margin call and all. But anyway, we'll explain it later on, huh? So what happens is, let's say you go short on this trade, right? And you're in a loss, right? Start off minus 20, minus 30, minus 40. When it gets to a total loss of $100, right? The broker will immediately close you out of that position. Automatically, you'll be closed out, right? So that you are never indebted to the broker. So at first you get into margin call. What used to happen back in the day is the broker would actually call you and they would say, hey, you know, Mr. Kevin, I heard you placed the position, this, but hey, your position is not performing quite well. If you want to keep it open, please top up your account. Then you just easily go, okay, top up your account. Then you continue trade, all right? So what happens now, we'll show you on navigating MT5, literally on your platform, it will start flashing red like this to tell you, you're now in margin call, right? But when it gets to a total loss of $100, you're closed out, my brother. Interesting, huh? Huh? That's how you blow an account. All right? Right, cool. Any other questions? No questions?
On leverage, there is the 1:500, the highest, or the highest ratio.
It depends with the broker. It depends with the broker. Others brokers offer all the way to 1:1,000. Others offer up to 1:500.
Okay, because mine is 1:888. Is it okay?
888. It's okay, my brother. It's okay. It's perfectly fine, huh? Right. Here I was just using an example. It's not to say that it's always that. Cool? Yes. Okay. Can we proceed, guys? Can we proceed? Are there any other questions? Okay, we have another question there. Okay, questions on questions today.
Okay, I just wanted to ask, is there a favorite leverage? Maybe if you want to choose leverage, is there okay, it's better to use 1:500 instead of 1:200. Is there any favorite leverage?
500 is a bit more flexible, right? It's an intermediate. Let me say, it's not too much, it's not too little. It's just okay, right? But yes, you can trade with bigger leverage. It does assist you as well in trading, right? But what matters above everything else is your risk. That's what matters, not your leverage. Don't worry about leverage. What matters is how much are you actually risking on the trade, huh? Okay, yes, sir.
I'd like to find out, like for a novice, where would you say they should start? Go big, go on leverage, or start with non-leverage?
Start with leverage, right? So when you guys are opening accounts, right? You notice that the broker will ask you what leverage do you want, right? Just go for, make sure your account is leveraged. You don't want to have this scenario, my friend. Imagine 3 months waiting for $10. Right? It's not worthwhile, huh? Right? So you want to have a situation like this where you are making substantial amounts of money. Cool? Okay. All right. So let's jump on to what we call margin. Right? What is margin? Margin, it is the amount of money needed as good faith deposit to open a position with the broker. Right? So what happens is this when you're trading on your platform, right, and you click buy, right, with your volume size and all, right, so there's an amount, specifically an amount that will be reserved aside, set aside, right, to keep your position open. Does that make sense? So if we were trading this, right, and we clicked buy right now, right, you'd find out that let's say our volume size is maybe 0.1, right? You find out our margin would be equivalent to $20. That $20 is the amount that is required to keep that position open. So let's say it then goes down below that $20. That's how you then get into margin call. Is that cool? Okay. So it is expressed as a percentage of the full amount of the position. Most brokers say they require 2%, 0 point that. Right. But there are also different types of margins. Right? The first one is margin required. Right? Margin required, this is the amount of money that your broker requires you. Right? If you want to open your position, this is the amount of money that you say, hey, no, you need to reserve this amount of money to keep this position open, right? Okay. Then there's account margin. This is just another term for trading bankroll. It is the total money you have in your trading account, right? So your account balance is 100, huh? Right? That's your account margin. That's the amount you can use for what? For placing other positions and all. Cool? Right, next. Used margin, right? This is the amount of money that a broker has locked up to keep your positions open. That's the one I was talking about, right? So you place a position today, right, with a volume size of 0.1, right? So the broker will just say, hey, $20 of that. This is the amount of money you need to keep your position open. Right. Margin call. This is when your broker calls you to add in more capital. When your equity falls below your used margin. This is typically done by red flashes on your trading platform. Right. So what will happen is this. You've entered a trade. Right. This one. You clicked buy, my friend. But then the trade is going down. So your account balance is 100, right? Then it's going down. But then your margin, let's say, is $20 as well. Right? So when you reach $80 negative, total loss is $80, your account, it will literally start flashing red on your platform to tell you, hey, you need to top up if you want to keep this position open. You need to top up, right? Okay?
It just means trouble.
Yeah.
So when it starts flashing red, it's trouble. I'm sure a lot of us here.
You've experienced it, eh? Before you blow an account, that's the first thing you see.
And you know what you'd have done was so wrong.
Yeah.
Right. Then there's usable margin, right? Also known as free margin. Right. Remember, you've placed your position and then it's taken up $20 margin, right? But then what about the 80? Right? That becomes your free margin. You might have placed the position on $rand, but you can still go ahead and place what? Another position maybe on Euro Aussie. Huh? Right? So that $80 becomes your free margin. Does it make sense? Okay. Next. Risk management. The last part. Okay.
Just to ask, firstly, sorry, how many of us here are risk takers? Naturally. Yeah, or no women? No ladies? Oh, one. Other ones not risk takers. Oh, okay, surprising. Would you say that you're disciplined when it comes to taking risks? Do you perform any form of due diligence? You do? Really? A lot of guys smiling here, you know. A lot of the times, I'll tell you some. Number one reason why most traders fail basically is failing to adhere to risk management principles. Because, I would talk about men, this male species, right? We happen to be quite ill-disciplined naturally, right? And money seems to solve a lot of things for us. right? It's actually quite easy. Doubling an account, we always talk about this, doubling an account it's not a hard thing to do, right? But you know, if you were to trade your $50 or $100 account and you double it to, you know, $200, that's what, $100, that's 100% profit, right? Okay, let's be honest with each other. Where else, in what other industry are you capable of, you know, having returns of 100%? Casino. Same concept though, same concept, yeah, but it's the same concept, which is why they have the same term in the casino, know when to walk away, right? Same thing with trading. People never seem to know when to walk away. And it's actually when people are making money is when they have the sense of euphoria and they have all these emotions running, which leads to them making the worst decisions possible. You know, the way you feel when you lose money, or the decisions you're most likely to take when you're losing money are the same decisions you would take when you're making money. It's equally as dangerous. So it's very important for you to be able to manage that particular psychology. So risk management is very important when it comes to the making of a successful trader. If you're incapable of calculating your risk, if you're incapable of being disciplined enough to maintain a trade plan which has particular parameters in regards to risk management, you're not going to make it. It's literally impossible. I'm sure those who are traders in here can attest to that fact. An inability to adhere to these principles leads to, I suppose, the worst case scenario being a blown account. Right, so explaining it is easy. The doing part is very difficult because of our own individual personalities. Women, on the other hand, tend to be better traders because they're more disciplined, so they're more likely to follow these set of rules.
Okay, thank you for that. Right, but risk management is very, very key. It's a key concept for Forex trade. Right. Okay, so I'm going to share with you some risk management tips, right, that will help you out with your trading. Is that okay? Is that cool? Right, but before we do that, right, I want to hear from you guys, your expectations, right? So, after we've done the course and you guys, you've learned everything, you're now perfectly fine and all, we've done all the theory, right? I wanted to find out from you guys, like, out of 10 trades, how many are you hoping are going to reach your target, you take profit, are actually going to work out? Out of 10, how many are you actually looking forward to and you're saying like, yay, these ones are going to work after this course? What? 5, I have a 5 there.
10 out of 10?
4. We're 4, we've got 10.
3.
We've got 3, we've got 7. Okay, the numbers seem to be going up. How about 8? How about a 9? I've got a 10. Yes, I've got a 10 over there. I've got a 10 over there. Right? How about 11 that side? Okay. So let's do this, huh? Right, let's get trading, guys. Let's get trading. So let's say this is you. So Monday, and you're about to trade. You're about to take 10 trades, my brother. 7, 8, 9, 10, huh? 10 trades. Right. You have an account balance of $100, right? You follow? Right. So let's say your actual risk per trade is $10, huh? Euro rand, long or short? Short. It doesn't work again. Ooh, something's wrong. Okay. Next one. Pound in. Pound in. Long or short? Short. Boom. Money is going, huh? Okay. Fourth trade, guys. Come on, let's go. Kiwi Looney. Okay, and then long or short? Long. Okay. And boom. This is the trading, guys. This is 4 trades wrong, huh? Or it was 2 trading?
Yeah.
Are we together?
Yeah.
Okay. Trade number 5. Huh? Oz. Euro, Aussie. Right? You're going what? Long. Okay. Then.
At this point in time, the panic has already happened.
Oh yeah.
It's a lot of new traders or just people in general are so afraid of risk, even more of actually losing. How many of us here don't like losing? Of course. All of us, right? No one likes losing. How many of us are okay with losing? How come though? Like it's when I always ask this question. People when people go into certain businesses, they're okay with making losses in those particular businesses, but when it comes to trading, there's a different attitude. What do you think, so? How many of us like confrontation? Confrontation. Yeah. See, very few. So it means people have a problem with confronting reality. Trading is so direct that you know at any given point in time where you stand financially. It's either you've been making money or you've not been making money. It's either you're currently losing money or you're currently making money. So people are not. It's very easy for me to be in a business, to own a chain of stores, yes, and have this assumption that I have been making money for the last 6 months, but technically I'm actually not making money, right? To trading, which is another reason people actually don't like journaling, because it's confrontational. People do not like to be reminded of all the mistakes they made, with all the losses they made. So in this situation, probably people start panicking after the second lost trade. You know, when you've just lost 2 trades, you get all these DMs at odd hours, 1 a.m. Man, should I still hold this position? Is it wrong? Is it correct? You know, it's very surprising. You have to be okay. You need to understand, a lot of the times people don't make it in trading also because they don't give it the respect or the discipline it actually deserves. Right? You need to know all the technicals, you need to know all the fundamentals. This exercise that Nash is doing is basically trying to show you that you can make all the money in the world from getting 3 out of 10 trades correct. If somebody was to get 10 out of 10, I guess we would have managed to solve world hunger, including the coronavirus, I suppose. if everyone could get 10 out of 10. Right? You need to understand, it's very... in a way, you do know that you're actually trading against yourselves. In a way. For you to make $100 profit, somebody has to have lost $100 profit. So in a way, you have to work your hardest to be able to be the profitable guy, not the guy who loses money. And that's a lot of work because you're trading against the best minds in the world. Yes? And that guy knows that it's okay to lose the first trade or the second trade or the third trade because they've gone through all the motions, they've gone through their plan, they're confident in their plan as well. And they, I suppose, very much so adhere to risk management principles, which is something that's very difficult to do. So it's a challenge for you guys, right? Don't be so fearful. If you're confident in your strategy, stick to it. If you're wrong today, that's fine. If you're wrong tomorrow, that's okay. Just have a system that you can use today and tomorrow and the day after that.
Thank you for that. Okay, so we continue. Yeah? Sixth trade. Give me a currency pair. Swiss yen. You're going long or short? Short. And then. Painful, huh? At this point, this is where some of you are now like, you know, best forex trading strategies, huh? You know, and then you're now looking and they're like, what is coronavirus really doing, eh? You're looking for updates and everything, you're not blaming it on so many things, huh? Right. Okay. But anyway, let's just say you continue, huh? Cool? Seventh trade. Trade number 7. You lose all the way to trade number 7. But you need to understand something. With trading, you don't need 100% win rate for you to make money. All you need is 30%. Oh, yes. Sorry.
Sorry to hold you on that. My question is, will you be trading on the same day or it's different consecutive days?
Yes. So the assumption is, let's say in a month, right? Your plan is, I'm going to trade 10 trades, right? Maybe in a week you do 2, maybe in another week 3, maybe in another week maybe 4, right? Okay, so all you need for you to make money is a 30% win rate. 30%, right? But you want to see where the magic is. You want to see how you can transform this $30.
Yeah.
Are you sure?
Yeah.
Okay, let me show you. So there's this concept called risk reward ratio. What is risk reward ratio? Risk reward ratio, right? Basically, this is the amount of money that you're willing to lose or you're risking on a trade in comparison to the amount of money you want to gain, right? So, for example, let's say I'm risking $10, but my aim is to make $20. You follow? Right. That would mean my risk reward ratio is 1:2, right? So, this is the minimum risk reward ratio you should have. For every dollar you risk, you should gain $5, right? Okay, right. Shall we get back to trading?
Yes.
Okay, so we're using risk reward ratio, huh? Right. So let's say in the last 3 trades, the trades work out, huh?
Yes.
Right. Boom. Remember, we're still risking $10. So I risk $10. I make how much? $50, huh? Because my risk reward ratio is 1:5. Okay. So here my new account balance becomes 80. Next trade works out. I make 50. My new account balance is 130. Right. Next trade works. My new account balance is 180. How much is my profit? $80. That's an 80% return from a 30% win rate. Can you guys see that you don't have to win all the time for you to make money? All you need is to have this risk-reward ratio, right? Whenever you are trading, always make sure that you insert your risk-reward ratio, right? We'll show it to you how you can easily do that. It's very, very easy. How you do the calculation, very, very easy, right? But the magic happens with risk-reward ratio. Do you get it?
Yeah.
Any questions? Yes, I've got a question over there. Got a question. The questions are coming. It's coming. Oh yeah.
Out of 10 trades, and
Out of 10 trades?
yeah. So is it 3 the least you can win, or what?
It's an average.
It's an average.
Yeah, it's the ones that you need for you to make money. Yeah.
You can either win more or less.
Yes, 100%. My brother, you can have what we call a winning streak.
Okay.
Wait, my friend, you just click buy. You don't know why, but it just works, right? It's possible. It does happen in trade, right? But here we need you to understand that losses are also there. They will happen in trade. Even professionals out there, professional traders, they also lose money. But what matters is when they're right, they're making way much more than they lost. You get it? That's what matters. That's why you need risk-reward ratio, right? Because it's the one that will enable you to make way much more than what you lose. Yeah.
So how do we set up risk reward ratio?
Okay, we'll show it to you. It's a very easy calculation. But let me just give you in brief. Is that okay? So, this is you. You're trading, right? Okay, you find an opportunity. Then, we haven't spoken about this part, but it's the next part. Okay, let me just include it. Cool? Right. So when you're trading, guys, right, there are 3 prices that you need to always set. There are 3 prices that you need to always set. The first one, right? The first one is known as an entry price, right? An entry price. Second one is known as the stop loss price. The last one is known as a take profit price. Right? This one is also known as an SL. This one is known as a TP. Cool? Right. Okay. So when you're trading, my brother, when you're trading, right, this is what happens. You click buy, right? Then you automatically get what we call an entry price. And in the markets on your platform, on your trading platform, it will be shown by a horizontal line like this. This will be your entry. Right? Okay. So think of your entry as your starting point, right? Let's say you guys are here at the Forex trading school, huh? Right? And when you guys are now leaving, you're not going home, huh? Right? But your initial starting point is right. And then you walk outside and you get a text, right? So your departure is the Forex trading school. Your entry is Forex trading school. Cool? Right. But where you are going to is home, huh? That's your target. That's where you want the taxi to lead you to. Right? The moment you get home, you drop off. You're no longer in the taxi, no matter even if the taxi is continuing going somewhere else, huh? Right? You drop off because you've reached your destination. Right? It's the same thing with what we call a take profit. Right? Your TP is your target. That's your home. That's where you want to go to. Right? The moment that the exchange rate reaches your take profit, you are immediately taken out for a profit. Right? Okay. But then, let's say, my brother, you get into the wrong taxi. Right? You're thinking that it's going to be taking you north, but it starts taking you south. Right? At some point, you have to say, I think I got into the wrong one, huh? Right? So, to minimize your loss, right, you then have to place what we call a stop loss. Right? So what will happen is the moment that price reaches that stop loss, immediately you are taken out for a loss. Does it make sense? So in comparison between take profit and stop loss, they are one and the same. They're different, right? In terms of In this case, you're closed out, right? Take profit, you're also what? Closed out, right? But then on stop loss, you're closed out for a loss. Take profit, you're closed out for a profit. Make sense? Right. Okay. So risk-reward ratio now, how you would calculate it? Very easy, very simple, right? So let's say this distance over here between your stop loss and your take profit, let's say that's 100 pips, right? We'll show it to you how you can calculate it on the platform when we're doing MT5, right? Okay, but then let's say the distance between your entry and your take profit is 500 pips. All right? So immediately this would be a risk-reward ratio of 1:5, right? Because the amount that you are risking is in between the space here of 100 pips. How much you're going to gain is what? In between this distance of 500 pips, right? So it's a very easy calculation. It's just a matter of calculating distance. That's all. It's ratios. That's all. Right? Okay. Any other questions? Last question. Yes.
So how much percentage from my account balance should I risk in one trade?
On one trade. Okay, good question. The basic, the standard. Okay. TK, you wanna answer that one?
So you probably want to risk 5% or 10% of your account. So if you have $100 account, you probably want to risk 10% each time you trade. So just to add, that risk has to be consistent. If you saw in this particular example that's on the board here, the risk is consistent the whole time. Right? From the $100 account, he was risking how much? $10 every trade. So each time he was wrong, he was losing how much? $10. Imagine what would happen if on the third trade you decided to risk $30. Would you even make it to the sixth trade? You didn't make it, right? Because $70, if you end up risking $30, you only have $40 instead of $60. So you might not even make it to the seventh trade, which theoretically or hypothetically actually is when you would have started getting your trades correct. So consistency is key. It's also key in the sense of when you're now assessing your results at the end of the week and just taking a look at your cycle, for you to be able to come up with any solutions or any adjustments to your current strategy or system, you have to analyze your results, which in a way should be very consistent. Your risk reward ratio, for example, needs to be consistent. Imagine on the seventh trade, which is the day you would have gotten your trade correct, had your risk reward ratio been 1:3, you wouldn't have made $50, but you'd have only made $30, which means that at the end of the cycle on the 10th trade, you would not have been able to make $180. So consistency is key. How much you're going to risk has to be consistent. Your risk reward ratio also has to be consistent across all trades. Answered? Don't risk 100%. A lot of us here, big believers, end up risking the entire account.
I answered, sir. Yeah. Okay. Any other questions? Last question.
My question is on the stop loss and take profit. There are some setups like the double top or double bottom where the TP, you're just supposed to put it where the price started to aggressively move up. Like the double bottom, right, where the price started to move up. That's where your take profit is. So I'm hearing like that risk reward of, let's say, if it's 50 pips, my take profit will be according to my risk reward. But what if that setup requires me to just put my take profit where, like the example I gave you of the double bottom of a bearing frag, something like that.
Okay. So basically, I think your question is, how exactly will I be able to know this is where I'm supposed to place my take profit or my stop loss? Generally, right? And you then came up with, you're not talking about the pattern side, right? We're going to jump into the patterns. That should probably be next after this. But the patterns are the ones that will direct us, right? Each and every single pattern that is there in the market has got its own specific rules. It's got where you're supposed to place your stop loss, where you're supposed to enter, and where you're supposed to place your take profit, right? So you have to follow the rules, and then also incorporate your risk-reward ratio in it, right? In terms of calculating the distance between your entry, your take profit, and then finding the distance between your entry and your stop loss, right? Because risk-reward ratio is the most important. It's the most important tool in trading, right? Okay. Any other questions? No questions? We're all good. We understood that part of the class. How was it? It was good. So we've all gotten accustomed to the language of trading. So you go home and then you just confuse them and you'll be like, you see, leverage, peeps.
Imagine how interesting it sounds.
Yeah. All right. Okay. All right. So let us jump into the next class.